Hello and welcome to this session in which we will discuss the components of the required rate of return. Now, the required rate of return, recently we saw it in the common stock valuation. When we looked at the formula, when we find P0 and we set P0 equal to D1 divided by R minus G. Now, what we need to do is we need to find out what is R, what is this required rate of return that helped us find out the value of the stock price. But the required rate of return is a percentage. So we need to figure out what is that percentage? How do we come up with that percentage? That's important. That's a foundational concept in corporate finance. So the required rate of return is central to corporate finance and stock valuation. So what is the rate of return? It's the return investors expect to earn for the risk they take. So the more risk you take, think about it this way, the more risk you take, the higher should be the required rate of return. But how do we compute this? This is what we learned in this session. How do we compute the R, the expected rate of return? Well, think about an office building, just to keep it simple for you so you could relate to what I'm trying to say. Think about an office building. You purchased this office building for $100,000. So this is your investment. Now this is an office building. This is an investment. Instead of this office building, you could have bought a stock, a security, a financial security. You could have bought a bond, right? You could have bought a mutual fund, some sort of an investment. You made an investment of $100,000. And let's assume, for the sake of simplicity, you rented out this office building and you got in rental income $5,000. So you rented out and the people that rented your office building paid you $5,000. Well, and that's after 1 year. Well, what's going to happen is this. This $5,000 is your return as rental income. If we take this $5,000 and we divide it by 100,000, we find out this is your rental yield or rental return. So you earned 5% on your money. I will make this example a little bit simpler. You deposited $100,000 in a bank account and they gave you $5,000 in interest. 5,000 divided by 100,000, your interest yield, you returned 5% on your investment. I hope you guys got the idea. It's pretty straightforward. Also, at the end of the year, you sold this building for $110,000. So after you got your $5,000 in rental income, you decided, you know what? I don't want to be in business. I don't want to be in this business. I want to sell my building for $110,000. You can also sell your stock. You could also sell your bond for a different price. Here the price is $110. So let's see how we computed the return on this investment. So the rental income is like dividend for our purposes if we're dealing with stocks. Therefore, your dividend yield, your dividend return, assuming this is a stock, is 5%. That's your dividend yield or your rental yield or your interest return yield from a bank account. It does not matter. It's what you returned. You kept the investment and that investment generated cash. That's the yield on the investment. It happens to be 5%. Your capital gain, what is your capital gain? The capital gain is how much you got for this asset when you sold it back. Let's assume you sold the building for $110,000. The building, you purchased it for $100,000. So you have a profit of $10,000 for an investment that you made of $100,000. Therefore, your capital gain is 10%. Your growth is 10%. Your capital gain is 10%. So the total return on this investment is 5% from the rental income and 10% from the capital gain. Your total return is 15%. And that's the first thing we want to learn about the total return before we dive deeper into the formula, the constant growth formula, which is P0 equal to D1 divided by R minus G. So what I want to tell you is the total return equal to your dividend yield plus your capital gain. And I showed you this simple example, but I am going to revisit this formula to break it down for you, to show you exactly, to basically to prove it from a stock valuation perspective. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Our corporate finance course is best for online students and students who are taking corporate finance courses. We cover financial statements, discounted cash flow, stock valuation, bond valuation, NPV and capital investment decisions, cost of capital, risk and return, as well as other topics. Our course includes lectures as well as multiple choice questions. Go ahead and start your free trial today. No obligation. We are here to help. Your success starts here.
So understanding the formula, so one common way to determine R by using the Gordon growth model or the constant growth model is to basically use the formula P0 equal to D1 divided by R minus G. Real quick, P0 is the current stock price, D1 is the expected dividend per share next year, R is the required rate of return, and we are going to solve for R, and G is the growth rate of the dividend. Well, that's great. If you are not familiar with this formula, please go back to the prior session, and in the prior session we cover in depth the Gordon growth model, so I assume you are familiar with that. Now let's isolate and find R by itself. So let's see, we have P0 equal to D1 R minus G. Let's multiply both sides by R minus G. P0 times R minus G equal to D1. Now let's go ahead and divide both sides by P0. If we divide both sides by P0, we're going to be R minus G equal to D1 over P0. Now let's add plus G to both sides. If we do that, we're left with R equal to D1 over P0 plus G. So we just rearrange the formula to find out what R is, and R equal to D1 over P0 plus G. This is what we end up with. So when we isolate, we figure out we have this formula. Hold on a second. Let's examine this formula a little bit closer. What is D1? D1 is the dividend. What's P0? P0 is the price. Hold on a second. What is that? What's that? What's that number? That's the dividend yield. That's the dividend yield. So if we take the dividend yield plus the growth yield, will give us R. And this is what I just told you earlier, that if we want to figure out what is the total return on this office building, we look at how much dividend yield we have. It happens to be rental, but I told you think of rental income because it's easier to understand, just like dividend and income while you're keeping the asset. And the growth is how much you sold this asset, your capital gain. Once you sold that building, what was the profit? And we're assuming it's positive, of course, here. So the total return equal to the dividend yield plus the capital growth, the capital gain, G. Now, let's look at this one more time. The R formula has two main components, the dividend yield and the growth or the capital gain yield. So what is the dividend yield? The dividend yield shows you how much you are getting back in dividend compared to the stock price. So it's the dividend divided by the stock price. The dividend yield is D1 divided by P0. To make it simple, let's assume you are receiving $2 dividend for a stock that you invested in $100. Your dividend yield is 2%. Now in the real world, every stock, if a stock pays dividend, the company will have to show the dividend yield. So for example, the Microsoft is $487.87. That's the stock price. And the forward dividend is $3.32. So if you take $3.32, if you buy the stock today for, let's make it $4.59, just for rounding after hours. So if we take, let me compute this real quick just to show you that if a company pays dividend, you could compute the dividend yield. And notice it says forward. It means what they expect to get next. 332 divided by 459, and the dividend yield is 0.6 0.7233. It's like rounding 0.73 of a percent. It's less than a percent. So the dividend yield for Microsoft is less than 1%. Let's just make it 0.75 of a percent. That's your yield, which is $3.32. Now, let me show you what would happen if you wait for tomorrow, and tomorrow Microsoft drops down to $400, just to show you how it works. If Microsoft drops down to $400 and they are still expected to pay $3.32 divided by 400, the dividend yield becomes 0.83. Then if the stock price drops again to 3-32, let me just show you 3-32, which is it was 300 not long ago, the dividend will obviously increase further, divided by 300. That's approximately 1.1% in dividend yield. Also, if the stock goes up to 600, your dividend yield will go down. So as the stock price goes down, this is the point I want to make here. As the stock goes up, guess what Microsoft would do? Microsoft will increase the dividend amount. This 332 might become 375 or $4 per share. Why? Because why would the stock goes up? The stock goes up because the company is generating more profit. When they generate more profit, they're going to have a higher dividend. As a result, it will catch up with the yield. Now, different companies will have different yields. For example, if you look at Walmart, they will have a different yield, different dividend yield. So you can compare company to company. You can compare their dividend yield. Okay, so that's one part of it. So this is the dividend yield. Let's take a look at this multiple choice question from farhatlectures.com. The price appreciation on an investment or a security expressed as a percentage is called what? So when the stock price goes up on an investment or a security, assuming a stock, is it the dividend yield? Is it the capital gain yield? Is it the current yield? Is it the total return yield? Well, what's the total return yield? The total return yield is the dividend plus the capital gain. Well, are they asking us about the total return? No, they're asking us about the price appreciation. When the stock price appreciates, we call this a capital gain yield. Capital gain means you purchase a stock for 5, you sold it for 8, your profit is 3. 3 divided by 5 is your percentage of the increase in capital gain. So what is the dividend yield? If you purchase a stock for 5 and that stock paid you $0.50, that's your dividend yield. $0.50 means what? $0.50, it's paying 10%. So 0.5 divided by 50, that's 10%. That will be the dividend yield if it pays you a dividend of penny. But if you bought it at 5 and sold it at 8, that's the capital gain. So they're asking here, it's the appreciation of the investment. That's the capital gain. Capital gain plus the dividend yield, those together equal to the total return. So the answer is B. Current yield is the current return, whatever that current returns happens to be at that point. So one more time, the total return or the total yield is the dividend plus the capital gain, which is the R component, the required rate of return. What should you do now? You want to go to Farhat Lectures, look at additional resources, multiple choice, true false lectures that will help you, whether you are an accounting student, finance student, studying for your CPA, CMA, CFA exam. Invest in yourself. That's the best investment you can make, and good luck.